your side.
Okay, let's begin. Good morning, everyone. Thank you for joining us this morning on a Friday. I'm Nadia Reed-Taylor from Leo Global, and with us we've got Megan Copley, partner at Leo Global, and Hugo is here joining us with all the tax insights. Hugo, good morning. And Greg Stockton from Global Residential, who's going to be talking a bit more about UK property investment opportunities. Meg, I think you start off a little bit on your background in the UK, and let's jump right in. We want to keep this webinar short and to the point. We know everyone's really busy, so we thought we'd just get started.
Brilliant. Thanks, Nadia. My name's Megan Copley. Joined Nadia at Leo Global. My background is in property investments. I've been working in the UK, recently moved to Cape Town, South Africa, to assist people in their journey in buying property in the UK. It can be quite a daunting experience, a different transfer process when buying property, but also so much choice. So many developers out here, telling you their developments best in class, etc. I think at the end of the day, what we want to see is well-priced property with a decent rental return that one can get a mortgage against and create wealth through property investment and a passive income in a foreign currency that's, maybe a hedge against the rand, pounds, dollars, etc. So our idea here today is to give you a bit of insight. Maybe you'd then choose to work with us. We hope so. So Greg on the call is a colleague I work with a lot in the UK. He's a UK property specialist. They go around, they take developments on, and they distribute through partners here in South Africa, and we're one of those partners. I would like to sort of use Greg here to tell you a little bit about Manchester and why people buy there. I know many developments, many reasons have been punted of why people are buying in Manchester. I think there's really, really good property, and then there's any property. And it's my opinion that Greg has access to one of the best developments in Manchester, which is a regeneration project. And I hope he can tell you a little bit about it. And then we can tell you about what that looks like as a buyer in long-term growth and in rentals. So Greg, over to you to tell a little bit about Redbank, if you wouldn't mind. You're on mute. Greg, you're on mute.
Yeah, thanks, Megan. Look, I think even before we get into Redbank and you just look at Manchester as an actual region for investments, my background, as you know, hasn't always been property. It's actually been investment management and financial planning for pretty much 2 decades. And a big part of that was advising clients on, where, what, and how to buy property within the UK. So, if we just look at forward forecasting over the next 5 years, UK property in general is poised to do just over 20% growth. In terms of regions, you look at London, 17% growth over 5 years, and then you look at the northwest, of which the biggest driver for that is Manchester, is poised to do just shy of 30%. So, I don't believe it takes necessarily a property expert or a rocket scientist to tell a client that if you're going to invest some money into the UK, you might as well invest into the area which is tipped to do the most amount of growth, which very, very clearly is Manchester. One of the reasons, or a few of the reasons for that, you've got this sort of corporate migration happening in the UK. So 80% of the FTSE 100 companies now are based within Manchester or have a base in Manchester. That's a huge difference to where it was 10 to 15 years ago, where any large corporation, had a home in London, and that was pretty much about it. So you've got this big corporation shift heading to Manchester, which of course is attracting lots of domestic and overseas talent. 13% of people that left London last year moved to Manchester, and these people are used to paying £3,000, £4,000, £5,000 a month for rents in decent quality apartments. So that then, when you translate it and you look at the city of Manchester, there's an absolute need to cater for these professionals that are moving into the city. When we go into a city and we agree that Manchester's the right place for us to be, it is then a case of, okay, well, what area within that city? Is it worthwhile taking on older stock? Is it worthwhile taking on something new that's shiny, off plan? And the reality of it is there's been an absolute shift in terms of tenant demand within Manchester, and to be fair, quite a lot of the UK cities, where people now are very much more amenity driven. They want things like co-working spaces, they want gyms, they want bars, restaurants, and everything else they can get within inside their home, to which a lot of people now either hybrid work or they're full-time working from home. And again, Manchester as a city hasn't always catered for that. So, you know, we very much recognise that that's the kind of product we wanted to bring to market. As always, we'd always like to get involved with regeneration zones, because again, without being too much of a property expert and just having a common sense hat on, if you can buy into a project which is in an area which is going to go through regeneration, typically that's going to make you a large sum of money when it comes to capital growth. So what's happening in Manchester is you've got the Manchester City Council did a JV with a developer called the Far East Consortium Group. They're a 50-year listed developer. The plan is, from a master plan, is to deliver 15,000 homes to house 45,000 people, create 7 brand new suburbs within Manchester. Across those 7 suburbs, you're going to have the biggest park within Manchester, which will run 113 acres, new healthcare facilities, schools. And I said it's divided into 7 subsections, one of which is Red Bank. So Red Bank will be the closest to city centre, you know, sort of 10-minute walk to Victoria Station, 15 minutes to shops and bars and restaurants. We started selling phase 1 2 years ago. That gets handed over in October this year. We're now into phase 2, into building 2, which obviously you guys have access to. And again, just when you look at that as an opportunity for a client, you know, you're pretty much walking distance to most major businesses, walking distance to city, across from what will be the biggest park. And yeah, it's just a monster project, but it's going to deliver and change the landscape of Manchester probably as we know it.
That's great.
Greg. Thanks for sharing that. I'm going to jump in, Meg. Just a little bit of background. I mean, part of why we are so focused on UK property is Megan and I we're wanting to personally build up our portfolios of properties overseas. And I think that's a big thing for our clients to know, that the properties we get involved in are properties that we personally would invest into and believe in. And I think that speaks a lot about what we're choosing. Meg has extensive background in the UK. Just wanted to add that in Greg, to why we've chosen you and why we've chosen what projects you're involved in. And as we know, buying in the UK is obviously, there's a lot of complexity that comes to that. I don't know if Hugo wants to jump in a little bit on the tax aspects to focus on, just to cover those briefly, because obviously there's a lot to consider when purchasing. Do you buy in a structure? Do you buy in your personal name? Over to you, Hugo.
Thank you, Nadia. Thank you to everybody in attendance. So I'm Hugo van Zyl. I'm based in Dubai and in South Africa half of the year. And I have a big client base in the UK, and they, like you, mostly non-UK residents. So most important is there's big changes coming on the 6th of April, probably dealing more with inheritance tax for the non-residents. But for non-resident investors, the big part is that you must get a UK UTR, a unique tax reference number, and you will be paying tax in the UK on your rental income. And unlike most other countries, the tax deduction for interest has been removed in 2020, but you can get 20% of the interest charge as a tax deduction once you have determined your tax liability. And absent landlords are best advised to go through an estate agent or rental agent so that you can reduce your monthly obligation to pay, because otherwise the estate agent has to collect a 20% tax, or the tenant in some cases. Very important is most people like to use offshore trusts or companies, or even UK trusts or companies, but the ATED rules makes it very expensive to hold your single dwelling properties or multiple of them in one single company, or a company per entity. You then have this additional ATED charge, and specifically where the property is more than 500,000. If you already have a property, just remember your ATED filing, that is due 30 April. It is not the same timeline as your income tax return, for which you have another year. So if your tax year ends 5th of April, you have till end of January of the following calendar year to file your tax return. But in most cases, non-residents will face a deduction on a monthly basis unless they go through the specific process to register and get that exemption. It's called in Form NLR1. But I'm not going to go into much detail. It's very important that one consults a UK specialist who either specializes in non-residents. So a lot of the UK-based tax advisors are not so clued up on the UK non-residents, so people that are not resident. And very important, from 6 April, UK moves away from the domicile rule, or less emphasis on the domicile rule. They're more moving towards the tax residency basis, including then worldwide income. And important, if you're a recent departure from the UK, so you're non-resident, but you used to live there before, just remember that for the AIHT or the inheritance tax, there's a 10-year tail. But your UK situs assets, that's the property you hold in the UK, will remain subject to AIHT, and the £325,000 nil band will apply to everybody. I think that covers the critical part, but there's obviously questions and answers, and we'll try and answer. But very important, do consult someone. The rules in the UK specifically is different for non-residents compared to UK tax residents.
Thank you, Hugo. I think just one other thing on that is you don't pay tax from zero in the UK. Your first £12,570 income is tax exempt, so it's 0%. So if you have a property and you're getting £1,000 a month, you do not have a tax bill at the end of the year on the first 12,570. So it only kicks
the profit element, correct? Yeah,
exactly. Your profit element. So there are deductions. Interest is not deductible in the UK. Hugo, would you mind just talking quickly about buying in a structure, V's, buying in own name, and at what level generally you might advise that somebody looks at buying in a company?
So generally, if the property is below 500,000, but very few foreign investors will be in that market. In that market, then it may be advantageous to use a company. The company capital gains tax rate in the UK is indeed lower than that for an individual. If you are on higher tax paying, you're over £50,000, then your capital gains rate is 28%. Otherwise, it's 18% lower than a corporate. So when you add the administrative cost of a company or trust, it's really, in most cases, cash flow wise, not advisable to buy in that. If it is because of the fact that you have a tax exposure in another country and you would like to shield it, so for example, you are resident in South Africa and you want to keep the UK assets out of your South African estate on death, then maybe look at it, and then it would be South African rules applying. But purely looking at UK rules, very seldom would we advise. And remember, when they say single dwelling property, it doesn't mean that if you add 5 properties, now you get out of ATED. Okay, so you could still be into the envelope tax and facing that tax. Also very important is that when it's a UK company, then obviously when you sell, the process is easier because that's a resident company. If you are selling as a non-resident, you have to report that capital gains tax to the UK authorities within 60 days. So that's very different to most other countries where there's either a withholding tax on capital gains tax when the exchange of contracts at the deeds office takes place. But in the UK, you have 60 days as a non-resident. So if you're buying several properties and therefore you are regularly buying and selling, then maybe a company becomes attractive because it's a UK resident and you don't have to do the quick reporting. You can wait till the normal tax filing date. But you have to pay the taxes during the year based on last year's profit. Also very important is that if you are using a non-resident company, that it does not shield you from AIHT or the inheritance tax in the UK. They have already had, since I think 2015, anti-avoidance rules that says that those envelope properties or that property-rich companies will be subject to AIHT. And in other countries, the property-rich company definition is 80% of the value is property, immovable property. In the UK, it's 75%. So very mindful of that. Thank you.
Yeah. Thanks, Hugo.
Yeah, I think people often jump to the conclusion of saying, let me structure it. I think it's a big South African thing we want to use structures for everything. And I think it's really important that, we look at it correctly, depending on what the client has, where they have it, and what they're wanting to actually do, and where they're planning to live in the next 5-10 years. Or they might go to Dubai. Hey, Greg.
Yeah. And I think another thing to mention on structuring is A simple way to purchase a property is in own name, and you can include up to 4 adults on a title deed. So that means four adults all own the property together. And Hugo can give more advanced tax advice as to what that means in a consult. But interestingly, that's quite a generous way to mitigate your tax obligations amongst the family or co-investors.
And one advantage there is that if you buy the 4 adults and you later increase your quota to a higher percentage, then you'd normally have no additional stamp duty to be paid. So your stamp duty is determined when you buy the property based on the then shareholding or participation interest. And then when you increase your participation increase, there's not additional, in most cases, stamp duty. When South Africa, for example, on our transfer duty, there we have additional, and also in the UAE, the minute the percentage of participation change, you have to pay the additional levies, which in the UK you in most cases can accept. The other benefit of having your, for example, children, if they are grown up into that, is that the effective tax rate, remember the roughly £12,000 exemption, you now increase that. If you then have multiple properties, you can spread that benefit to most other people. Unfortunately, in those cases, then you will not qualify for it, even if you spend 90 days a year in the property, for the rollover, the additional rollover upon death, because we have the 325,000 and then we have the 175,000 additional for if it was a house that you occupied or residential unit that you occupied for 90 days during the last tax year before you died. When there's multiple owners, those I understand is normally disallowed.
Thanks, Hugo. I think it's really interesting to bring it round and to explain the structure. And this can bring us back to, some values to consider and what to purchase in the UK. Initially, when buying property, I know I get asked the question all the time, I just don't have that much money. It's not a nothing exercise, but I think it's more achievable than people believe it can be. Certainly speaking of a project in particular in Manchester, where you've got payment plans over a period of time and a build phase, and maybe Greg, you could speak a little bit to that, just what you're saying at the moment in terms of a nice long payment plan, which give investors the opportunity to make this a 2-year achievement project, as opposed to something that they've got to do right away and have the cash available immediately.
Yeah, I guess there's always 2 things to consider, isn't there? There's your upfront cost, and then there's your actual cost of when you complete on a property. So one of the things we do like and love about the Kingfisher project in Manchester is that payment plan, because the completion date of the development is until Q1 2029. So the way they've structured the payment plan, let's say on a £400,000 unit, it'd be £40,000 this year, let's say April 2025, which would be 10%, 5% April 2026, 5% April 2027, and then the balance on completion Q1 2029. So what we found with certainly South Africans is that gives a lot of South Africans an easy way to use their annual allowance, without having to get clearance, because it's under that 50 or under that £1 million a year allowance that they have. But obviously, like all things, you do have to consider your completion costs as well. So, general rule of thumb is for every £100,000 worth of value you're looking at, you're probably going to need about £40,000, I would say. I mean, you might have a different opinion. I think that's usually how the numbers work. For every 100 grand, you need about 40 to complete in total. But yeah, that's why we like that payment plan: 10% this year, 5% next year, 5% the year after, and then nothing until Q1 2029 in probably what is the best project in Manchester at the moment.
Greg, maybe give us an example of a price point. Where is it starting? Like a 1-bed, what would be the best one to focus on from an investment point of view? Take average South African going, I haven't bought in the UK, I don't know where half of it is. We've been to London. Typical investor maybe says, great, I'd like to have a look at the UK. Where do I start? What am I looking at? I think that would be quite helpful.
You mean specifically for Manchester in this project, or UK property in
just
general?
as an example for that building, the one that's coming up now.
For that building, yeah. if I look at the majority of sales we've done in the past couple of years within this project, whether it be this development or the tower before the tower, most of them have been 2 beds, to be fair. Reason for that is you do tend to get a wider tenant pool. You know, you've got obviously wealthy individuals that will take a 2-bed. You've got a young couple that will take a 2-bed with maybe a child. You've got 2 professionals that can share. So your tenant pool is obviously a lot wider with a 2-bed. So you tend to get better rental yield. They value up a lot better on the secondary market when you come to obviously exit, because again, it's not just about buying a property. If you're looking at it for investments, it's about, you know, what's the end result and how easy is it to sell. So yeah, look, with price points for 2-beds have started around about the 385, 400 and gone up to around about the 470. But again, what's been quite interesting in Manchester is every single time a new development comes to market, the ceiling just keeps getting broken. You know, the W residences, they got launched last year. 2-beds were selling at £650, £60,000. I think Nobu residencies are going to launch at some point this year. They're coming at like £900 a square foot, apparently. So the ceilings of property prices just keep getting broken time and time again in Manchester. And the benefit of this is you're locking in, you know, sort of £550 a square foot, but you're not taking delivery till 2029. So it's like, from an investment perspective, when you look purely at the numbers, it's unreal.
I think what's important to mention here as well is, you know, people are nervous of off-plan. We've got a different type of governing when it comes to off-plan in South Africa. In UK, you've either got a protected deposit or not. This project is a fully protected deposit, so your money goes into a kind of escrow. When you buy at the 10% and say you exchange your contracts at that time, you lock in the price point of the property. So you lock in a 2025 for a 2029 delivery. Many people might ask us, well, I'm losing out on 4 years rent. I really wouldn't look at it like that. You're gaining a price point at today, this year, for a development that's going to continue, as we said, 15,000 homes. So there's multiple buildings within this project that will continue, and it's all being phased in a very organized way. So it's not ad hoc, it's one developer. And each time they launch a new building, a new price point and a higher price point. So therefore, as an owner in an early phase, by the time you take delivery, the prices of 2-beds will be far, far greater than at the point at which you invested. So the growth is what we are essentially locking in, the capital growth, as opposed to rental now for something that's built. And that's the real big difference here. And rental comes with, you know, other hassles and stresses. But for the moment, you enjoy 4 years of property price growth with no requirement of a tenancy.
Greg, what would, for example, the numbers be? Sorry, I'm jumping in here. If the property says £400,000, what is the payment plan? If you had to roughly throw the numbers, I know this is throwing you in the deep end a bit. But if you had to say with the deposits, what would you be paying in each year?
So, and I think this is interesting because it kind of answers, like, or validates Megan's point as well, is that if it was a £400,000 unit, this year you'd be putting in £40,000, next year £20,000, the year after £20,000. So that is your full deposit, right? So you've put in £80,000 in total, but actually then you end up with a £400,000 asset that's going to grow by 2029. So even if you just imagine it has a 20% uplift, that £400,000 unit is now valued at 480. Well, you've only paid in 80. So technically by completion, you've doubled your equity, 100% growth on your capital that you've added into that. Now, of course, then you go to get a mortgage. If you've got 70% loan to value, which we're seeing a lot right now, you'd need to put another £40,000 in because you still owe 10%. You've got some stamp duty. It's going to be around about, depends on if it's a first time or not, but, you know, let's call it 30 to 40,000 pounds. Then some mortgage fees and et cetera, et cetera. So usually we cash flow this all out for a client, so there's full transparency over that. And then ultimately we look at what the exits are like within a 5 to 10 year period. So if a client either sells or refinances in 5 years, what does those numbers look like, and what does it look like in 10 years? And usually they're very positive, from sort of 10 to 15% per annum is an average. But without a lot of volatility, which obviously other asset classes can give you. It's quite a clean investment.
Yeah. You know me, I'm a numbers person, so everything goes onto an Excel. Like Meg's laughing.
That's one of the biggest mistakes.
Sorry.
It's one of the biggest mistakes people make is they buy on emotion and not numbers. And
Yeah.
if it's investment property, it's all about the numbers. That's the only thing that really does matter. So as long as you've got a good project that you can clearly see, a good fair value to purchase, good story for growth, good rental yield, and a very good exit, i.e., somebody actually wants to buy your property in 5 or 10 years, and there's real value in it, then as long as the numbers stack, it's usually a go.
And I agree on the numbers. I just wanted to add
Yes.
some of the numbers to be taken into account is that remember in October, the current Labour government changed the stamp duty or SDLT rates, and it again changes in April, and the zero band now drops to £125,000, so it's relatively low. And then non-residents, if you're your general home or regular home is outside of the UK, then you are facing the 2% additional stamp duty as a non-resident, and that's from the first pound.
Yeah, exactly. 2% overseas charge,
And I think importantly on this is it's hard for anyone listening to visualize, but if you are looking to make a single decent investment into the UK, I think this FEC, Far East Consortium, Manchester Council project, which the original phase is called Red Bank, is an interesting one to consider. With the development of Park, it can be likened to any big park in any city. So the sheer size of this park and the homes surrounding it, which is what this build is going to be, this regen scheme, can be a bit like Notting Hill Holland Park, Central Park, you name it, it's very near the center of the city. And so there's a full presentation that Greg and myself can do to you to show you exactly what it's going to look like, price points and the different options available and what's sold, which is really important because, one point to make about the UK property market is that it has history, it has credibility, and we can prove the prices that have been achieved to date. This information is available on websites to anyone buying there, and that's what I like so much about the market is the visibility. So we can show you what others have done, what others have achieved, and how they've then sold that property. And this is not just all talk.
Okay. If you're looking,
yes, please.
If you're looking at the 2 bedrooms and additional, just remember, as Greg mentioned, for the South Africans, because I see there's a few Afrikaans surnames on the attendance list, is that you qualify for 1 million rand single discretionary allowance per person, adult person 18 years or over. So therefore, coming back to what we discussed earlier, buying with multiple, say 4 grown-ups in the UK, then you have 4 million to take out, and you can then buy in a better property. And quite interesting, if, for example, 4 parents and 2 children take money out, at this stage, exchange control wise, it is not allowed to put it into a joint bank account without permission. You need permission for that. But because that property is registered in all 4 names, there's no prior permission required to pool the funds. So it's also very important as the project completes is that this 1 million is a calendar year allowance in South Africa. It's not a tax year allowance. So by January, you can qualify for another R1 million. Then also very interesting, it's just recently in the budget, if you were flying into the UK and you were on holiday and you came back to South Africa, you always had to cash in your pounds and put it back into rands. You can now, as of budget date, you can now bring it back and put it into a foreign currency account. So you can either now use a debit card, create a debit card, and it is then put in the account as pounds, and it can stay in that account when you come back. Or you can come back and put the pounds you have into a pound account with a South African bank. So you can build up. If you are not required to spend all the money because the development is phased, then you can build up and keep that money for the next year so that you can then add up or top up so that you can afford a better unit. And I think that's very important for the rental side. From my client base buying in the UK at the moment, and specifically Manchester, Greg, I don't know how prevalent it is for everybody. On my client base, it's a lot of people actually working in London, but now allowed to work remotely. Therefore, they're looking at Manchester getting better value for money and probably, as you mentioned, better growth or return. And therefore, they are looking at the 2-bedroom apartments because they need that extra, let's call it a study. And in the UK, if you, for example, are resident in the UK and you buy a property from which you work, you also, like in South Africa, like in America, can get the home study or home office deduction.
Thank you, Hugo. Interesting as well, I think, Hugo, you touched on it. Things like opening a bank account in the UK, not so straightforward, but we can assist with that. And we've got partners in the different banks, but also getting a mortgage in the UK as well. That's, you know, it is something we do. We take this on full service, and we're not expecting you to know what to do. We'll guide you along the way. So going from talking about, you know, close to 10 million rand for a property in the UK, I do want to open, you know, the door a little bit in an earlier price point. There are projects that we've got available from 100,000. What we look to do there, our strategy, just a little bit about it, is, you know, Manchester. Oh, there we go. There's Red Bank, Greg's background. Thank you. So this is the project we've been speaking to you about in Manchester.
Felt like that with all the jazzy backgrounds.
Yeah. Thank you. Now we're all jazzy. So in the UK, you've got your main cities. You've got your, you know, London, Birmingham, Manchester. I think what people forget is that those cities are, you know, trains and commutable to smaller villages and towns just outside. Those villages and towns attract, you know, many people to within commuter distance of the city or town that they're working in, and therefore also offer a great opportunity for investors. The average homeowner in the UK is still around 40 years old. So before 40 years old, they need housing. That housing is obviously comes in the form of an assured short-hold tenancy, of which you would be the landlords. So when looking at that, you can look at commutable towns where you'll get a good quality tenant, nicely referenced, maybe a young couple working in, good example, a marketing and a business development job in the center of Manchester for a good company, one of the FTSE 500s, and their salaries will be, you know, 20 to 25,000 pounds per year, and then they're looking to rent for about 1,500 pounds a month on average. So if you look outside of the main city centres, that's probably where they'll go to live, and that's where we also look for rental opportunities in good quality properties. So practically speaking, you know, taking the confusing hat off, this is what that looks like. And therefore, if 400 is a bit daunting and you just want to dip your toe in the water, we've got projects in Bolton, which is about 10 minutes outside of Manchester, projects in Halifax and in Hull, which are all commutable to your main cities where one might work. This as well, just to go on to that, is long-term let. We also offer opportunities for short-term rental. Short-term rental, there's a major demand for this. If you imagine a regeneration scheme of 15,000 homes in Manchester over 10 to 15 years, all the resource, the engineers, the contractors, they don't just live in Manchester, they need to come down from somewhere, and they'll be working during the week, and during that week they need housing. And that housing is generally just on the outskirts of those city centres. So we also look to buy property which can be offered as a commercial let, a short let, to these businesses looking to house their employees. So, you know, these are all the different strategy approaches we take, just some insight. Obviously, better to speak to someone directly, but I wanted to make mention.
Meg, maybe give a bit of an indication of what kind of yields people could expect, just to get an idea, because I think most of our reference is local.
Sure.
Look, kind of projects.
When I speak to people who have invested into property in South Africa, they talk about, you know, great big yields in different parts of the country. We've got different tenancy laws in the UK. I think generally a more reliable tenant, and more reliable tenancy laws, and an offering around tenancies. You know, we've got independent adjudicators where deposits are concerned, and quite strong laws around rent payment in the long term. So when talking about yields, they're not always double digits, but to remember that, you know, the currency volatility is a lot less than where we are now, and rental returns in single figures in pounds represent a very good comparison when making a comparison around money growth and property growth in the year. This is a bigger conversation. So if you're looking at a long-term yield in a property like Redbank, which is going to grow over time, you're probably looking at a 5-6% yield and a nice capital growth over time. If you're looking at the outskirts of a city centre, you're going to see a slightly slower capital growth, but a higher short-term rental yield or long-term rental yield. So you're talking close to 8, 9, 10%. So depending on what your prerogative is, if you're looking at this over 15 years and you want a higher value property, you want to take advantage of the growth of Manchester, and you're happy with a lower rental yield, then that's the project. If you're looking to get a very high rental yield, you need an income at the moment, then look at a property on the outskirts that offers a short-term rental potential.
Thanks, Meg. I think, Greg, just a little bit about your background. I think it's hard to comprehend how big this project actually is. When you first introduced it, it feels like you're building an entire city in a way. Do you want to just go over a bit how many buildings there are, how many are completed, where we're at in that project, just to give a bit of a frame of reference?
Can you hear me?
Yes.
I just got a notification to the audio wasn't working. Yeah, so I mean, the stack of towers you can see kind of behind me there represents about 10% only of the entire master plan, just to kind of give you some context. So yeah, just where you can see behind is only 10%. So we're going to have units to be able to sell to clients for years upon years. When you add all of the 7 suburbs up, I mean, technically you mentioned about building an entire new city, but all said and done, when completed, it's going to add about 27% mass to the entire city centre. So it is a huge project. But you know, as I think Hugo alluded to, maybe about Megan, you know, there is a chronic undersupply of property. So you know, they're not building something that's not absolutely needed. They're expecting circa 50,000 people to descend on the city centre over the next 10 years. A lot of those are with professional mindsets, and they are going to need somewhere like what you can see behind me to live, which a lot of these buildings either have their own or they've got separate amenity clubhouses with things like, you know, gyms, fitness suites, yoga studios, co-working spaces, rooftops, bars, restaurants, and all of that. So it's going to be a very cool new destination in Manchester, and that's the reason I purchased in there myself. You know, apart from obviously advising clients to buy, I bought myself in there because I can see that massive upside, and I can see how Manchester's just, you know, changing on a day-to-day basis. And you know, whilst you can pick up some older kind of apartments in the city, 2 beds for maybe like 250, 300 grand, a lot of them, again, you know, they're not what you class as sort of A1 desirable apartments. You know, the market's moving towards amenity driven, you know, similar to Dubai right now. You know, you walk into an apartment here, the first question you ask is, where's the pool and where's the gym? Not does it have it? And I think Manchester's becoming like that as well, similar to London. It's just finding places to build where you can have the space to add these things in, which is what you've got here.
And the Parkland as well. You know, Parkland adds at the very least 10% to a property value, but it is and always has been the most desirable areas to live in the UK are around or near to Parkland, Hyde Park, Notting Hill, Holland Park. You know, those are the most desirable areas in London, and this will be without a doubt the most desirable area to live in Manchester as well. So it's not yet an area, it's a regeneration, it's coming. But I think anyone who got in early in Notting Hill, which used to be a bit dodgy in the 90s, is singing at the moment.
Yeah. Just to put it out there, if anyone does have any questions, you're welcome to post on the Q&A. We will cover them. But I feel that we've covered pretty much the broad strokes of everything. You know, if any clients are specific,
I would like to add something, if you don't mind.
Please, Hugo, go ahead.
The last thing is it's the estate planning from a UK perspective. So we suggest that because of the probate rules in the UK, that the minute you have a title deed property or an interest in a title deed property, that you ensure you have a separate UK will. And UK has the AHT. And for example, if you're living in South Africa or UAE or America, where it's $12.5 million, you suddenly face UK AHT at 40% above 325,000. So one of the ways to plan for that is to indeed take out a life cover insurance, and typically a life insurer that's based in one of the Channel Islands or Isle of Man. They're most attractive because those proceeds are not included for AHT in the UK. And if you're South African resident, if it's a non-domestic policy, which means it's a policy, life policy outside of South Africa, and it pays into a foreign bank account. So going back to that comment, do open that foreign bank account the minute you start buying the property, so that the proceeds on that life cover can pay into that. Then that non-domestic policy or the pound life cover can then be used to pay the UK IHT, but it will not add to your South African estate duty. So it's very important that people also look at the estate planning side. Once you have investments of this value in the UK, I am not a lawyer, but behind me is that SL Law, that is a joint venture partner of ours, and Stefan is a UK solicitor, so he does help my clients with UK wills, and I'm sure you have a team of members that you can refer to. So very important that you have to look at your estate planning, dealing with the UK probate rules, which is applicable because the properties are all well in excess of that probate rules, plus in most cases, it will probably be above the AHT exemption unless owned by multiple. So that's the other benefit of 4 owners. You have then £325,000 no band multiplied by 4. Thank you.
Exactly.
Hugo, thanks for that. I think a big component with a lot of our clients, the reason they purchase overseas is to build something up for their kids in the future. So I think that's really important to make sure all aspects have been taken into consideration. And I think that's also what's quite important to Meg and I, is we're not just here to show some properties, say, here, buy this, off you go. Our focus really is on building international portfolio of properties for ourselves and helping our clients in that process. But I think that's it for today. We wanted to keep it short and sweet to the point. And just want to say thank you everyone for joining, and thank you, Greg, thank you, Hugo, and have a lovely weekend.
Reach out if you would like.
Thanks, everyone. Take care.
Thank you, and thanks for everybody joining. Much appreciated.
Thanks. Okay, cheers. Bye.
Bye-bye.